Hello Accounting 101 students. In this video, we're going to go over some equity transactions with question number 5. And one of my suggestions for a question like this is to keep track of the number of shares that you have issued and outstanding all throughout the problem. That's one of those things that will help you when you have some additional questions that may come up in other problems. So in this problem, we start off on January 1st with 61,100 shares of common stock outstanding. And you want to keep track of the number of shares of common stock that is outstanding all throughout the problem, because you need to know the number of shares outstanding in order to do your dividend calculations. So this stock has a stated value of $4 per share. So in the first transaction on April 1st, the company issued 9,900 additional shares of common stock for $11 per share. So we're going to note that on April 1st, we're going to add in an additional 9,900 shares, and that's on April 1st. And our initial shares was on January 1st, the existing shares. So now I want to know, well, what's my total number of shares that are outstanding at this particular point in time? So I'm going to add up both of these numbers to notice that I have 71,000 shares outstanding so far. So in this problem, it only tells you that you need to prepare the entries for the 3 dates that involve dividends. But as a review, I'm going to include in the journal entry for recording this transaction. So on April 1st, we're going to debit cash, we're going to credit our common stock, and we're going to credit our additional paid-in capital, in excess of par on the common stock. And this is kind of like a long account title, but you do need to learn this account title for this particular class. So next we need to put in the dollar amounts. So the dollar amount for the cash is going to be, and I just have to move things over a little bit just so you can tell the difference between what accounts are debited and credited. For cash, we're going to take 9,900 times $11. So our cash amount is going to be 108,900. Then for the common stock, I'm going to take the number of shares and I'm going to multiply this by the par value. So it's going to be 9,900 times $4 par value. That will give me my 39,600. And the difference is going to be reported as a credit into this account, additional paid-in capital, in excess of par. So it's going to be the 108,900 minus 39,600. So that's going to be 69,300. And I just did this as additional practice. You don't necessarily need to know this for the problem itself. Now we're going to get to the June 15th transaction where the company is going to declare a cash dividend of $1.70 per share to the stockholders on record. So we're going to debit cash dividends. And this is the dividends account that we referred to when we did our retained earnings calculation, where we take the beginning retained earnings, add the net income for the income statement, and subtract out dividends. So this is the same dividends account that we're talking about in order to get to the ending retained earnings. So I know I have 71,000 shares outstanding times $1.70 per share for this dividend. And when you multiply that out, you're going to get 120,700. And the same amount will be credited. And you're going to debit cash dividends and credit your dividends payable account, which is going to be a liability account because in this problem, it didn't say that it was paid yet. Now, on July 10th, that's when the company paid this cash dividend. So on July 10th, we're going to debit dividends payable and credit cash for the same dollar amount. So 120,700. Now on December 1st, the company issued 4,400 additional shares of common stock for $11 per share. So I'm going to scroll down for a minute just so we can get in all the information from all of these transactions. I'm just going to be moving around a few of these notes. All right, so now we're going to be recording December 1st. And even though it's not part of the problem, it's good just to refresh our memory on the journal entry for recording the issuance of common stock. Include a little text box here. All right, so this is on December 1st. We're going to debit cash. And the amount that we're going to debit cash is going to be 4,400 shares times $11 per share. That's the market price per share. So it's going to be 48,400. We're going to credit common stock by taking the number of shares times the $4 par value. So 4,400 times 4. Gets us 17,600. And we're going to credit this long account title again. This time I'll abbreviate this, additional paid in capital in excess of par on the common stock. And we're going to just take the dollar difference between the cash, which is the market price, minus the common stock at the par value. So we're going to credit 30,800, and this is just for reference. So now when we're thinking about keeping track of the number of shares that are outstanding, we're going to add an additional 4,400 shares on December 1st. So now our total number of shares is 75,400 shares outstanding. So when we get to December 15th, and we're going to do our last journal entry, we need to go ahead and consider the new number of shares outstanding. So with our new number of shares outstanding, I'm going to record on December 15th our cash dividends and dividends payable. And I'm going to take our number of shares, which is going to be 75,400 times the amount that's being issued per share of $2.20. Which is going to be 165,800. $8.80. So for common stock, you want to realize that a company has its own discretion in terms of determining the dollar amount that they want to issue per share. They are not required to issue any dividends on the common stock. There is some differences when it comes to preferred stock, so you do want to read about that part in our textbook. And you also want to pay attention to whether the dividend has been paid or not paid. For dividends, there are 3 dates that you want to be aware of. There is the declaration date. So the declaration date is the date that you're going to be recording the cash dividends and the dividends payable, because that's the date where the company has declared the dividend and they have made a promise to pay the dividend to the shareholders. And there's also the record date. So that determines who we're going to be paying the dividend on. So who are the shareholders on records as of that particular date, because there could have been some movement in terms of ownership. And last, we have the payment date. So on the payment date, we actually pay out the dividend. So we're going to debit dividends payable and credit cash. One of the important things to notice is on the record date, there's no journal entry. So that's just determining who to pay that dividend out to on the payment date. Thank you for taking the time to watch this video.